Cryptocurrency has witnessed remarkable growth in the last few years. However, some people still view cryptocurrency with caution and have a limited understanding of what it is. However, investing in cryptocurrency can be a good idea. Cryptocurrency is risky, but it has the potential for high returns. This chapter discusses the reasons why you should consider investing in cryptocurrency. It also highlights the risks involved in cryptocurrency. High returns. Cryptocurrency has been around for a short time, but it has been touted as highly profitable compared to other forms of investment. A cryptocurrency can immediately show solid changes in price over very short periods. For instance, you can expect to get a return of about 20% of your investment, which is a fair result. It is not easy to find these high profit levels when you decide to trade in other assets. However, to succeed in crypto trading, you must have a solid strategy to use as a framework. Just like any other kind of trade that you may think of, crypto trading requires you to have a plan. In this plan, you should outline your goals and what you aim to achieve within a certain period. The chances of losing money will be very high if you try to trade in cryptocurrency without a meaningful strategy. Transformational technology. Cryptocurrency is also known as digital technology, and it can be a game changer in the global economy. The blockchain technology that underlies different cryptocurrencies can impact various industries like healthcare, shipping, banking, and supply chains. Cryptocurrency does not rely on intermediaries like fiat currency when performing transactions across borders. The distributed ledgers that strongly depend on computer networks make cryptocurrency independent. With cryptocurrency, you can buy directly from another business in a different country, and you can perform the transaction directly. If you perform a wire transfer involving fiat money, it could end up going through various banks, and the entire process can be expensive. The exchange rate involving different currencies can also affect the ultimate price you pay for doing business with other global companies. Cryptocurrencies promise a smooth passage of transactions within borders without the involvement of regulatory authorities like banks. Cryptocurrencies can make attractive investment opportunities for people interested in earning high returns while at the same time supporting new technology. Regardless of geographical boundary, you can use cryptocurrency of your choice from any place without the hassles of foreign currency exchange rates that are often distorted. Cryptocurrency is a global currency that can revolutionize the financial services sector and banking without paying high fees. Enlightened businesses are accepting cryptocurrencies as a form of payment in different places around the world. As time goes on, there are chances that the digital gold will make sweeping changes to the global economies. Therefore, investing now in digital currency can give you a comfortable seat as we move into the future that is characterized by constant changes. Store of value. Gold is commonly viewed as a stable source of value among different types of precious minerals. Bitcoin in particular is regarded as the digital gold due to its censorship-resistant and deflationary properties. If you are worried about issues like bank failures, natural disaster scenarios, and hyperinflationary events, you can invest in cryptocurrency. You have observed in Chapter 3 that cryptocurrency is created through the process known as crypto mining. This process involves the use of computers to solve sophisticated puzzles, and a group of miners usually does it. Unlike fiat currency, this simply means that cryptocurrency comes in limited supply since mathematical algorithms are used to cap it. In other words, it means that it is not easy to create cryptocurrency like paper money that can be printed without anything to back it. Politicians and central governments often resort to printing fiat currency to satisfy their egos, but this often leads to inflation. Oversupply of money in the market erodes its value. However, no single government can wield control or dilute the value of cryptocurrency, which can subsequently lead to inflation. Cryptocurrency is based on speculation. The price of cryptocurrency is usually determined by speculation, and this can help you generate high profits from your trade. Many investors buy cryptocurrencies in anticipation that the value will increase. Therefore, if you buy and hold your cryptocurrency, you are likely to generate more profit when you sell it shortly. Elements like speculation strongly determine all types of trade. Since crypto trading is still a new concept, speculative behavior should be expected. However, Traders need to be careful and avoid falling into traps like herd instinct and the greater fool fallacy. There is a difference between a foolish risk and a calculated one. No one can take your cryptocurrency. Naturally, cryptocurrency is cryptographic, which means that no government can confiscate your crypto without your cooperation. Cryptocurrency offers you a high level of independence that you can never do with fiat money. When you bank your money, you can wake up with nothing or valueless notes when the money is eroded by inflation. The other problem with fiat currency is that the bank can go bankrupt or be robbed, affecting all depositors. However, with cryptocurrency, you are 100% secure since no one can tamper with your crypto. No financial institution is required to keep your cryptocurrency or to facilitate any transaction where you can end up being charged exorbitant fees. It can be observed that cryptocurrency can decentralize the global economy where a few powerful countries do not control it. You can invest in cryptocurrency now if you want to enjoy hassle-free transactions. High liquidity. Cryptocurrency consists of high liquidity, which means that it is easy to buy or sell. There are different tools that you can use when trading cryptocurrencies which make it easy to trade them. Tools such as limit order or automated buying and selling help protect your investment. You can use the option to cap the limit of currency that you want to trade. The good thing about this strategy is that it automatically stops when you reach the expected ceiling of your trade. The other important aspect is that it is easy to join in trading cryptocurrency. You do not necessarily need to deal with any institution like a bank or sign any papers. All you need to do is create an account on the preferred platform, depending on the type of crypto you want to trade in. After creating a wallet, the next thing is to learn how to trade using a demo account. When you are ready, you can begin trading and track your assets, and this stage is very simple. Favorable forecasts. Every trade comes with some risks that can lead to a loss of money. Price fluctuations and market volatility are very common, and they significantly impact your trade. Short-term losses in crypto trading can be hard-hitting, but it is easier to study the trend in crypto trading. Many forecasts in crypto trading indicate that investing in the long term can reap significant benefits in the next 3 to 5 years. Many cryptocurrencies are undergoing a downward trend, but there are indications that the prices will once again shoot up. Therefore, you can capitalize on this potentially high return investment, though it comes with high risks. The benefits that you will get are likely to offset the risks that you are likely to face when you make a long-term investment. Investing in cryptocurrency can go a long way in helping you diversify your portfolio. This will help you gain a better understanding of how the world of cryptocurrency functions. Once you involve yourself in crypto trading, you will gain significant hands-on experience, which will help you make informed decisions. Once you take part in crypto trading, you are also likely to research different topics that will help broaden your understanding of digital currencies. You need to choose your investment wisely and know that cryptocurrencies are not created equal. Do your research first and make sure that you choose the right crypto that can give you leverage to succeed in your trade. Common features of cryptocurrencies. As you have observed in this section, cryptocurrencies generally share some similarities that you should know. As a recap, the following things that you should know before you decide to invest in cryptocurrency. Cryptocurrency constitutes transformative technology that can transform the industry. Crypto provides a safe store of value, offers high profitability, high liquidity. Your cryptocurrency cannot be tampered with. You need to show some keen interest to learn if you want to succeed in crypto trading. Investing mindset. If you want to become a successful investor, then you should start by developing the right mindset. You should build a strong investing mindset and be prepared for tough situations that you are likely to encounter. If you want to succeed in your endeavor, you must have a sound financial plan and the right frame of mind. If you are a newbie in crypto trading, you should treat it as a business like any other type of trade. Essentially, you aim to generate some profits from your trade, and this is the major driving factor that should help you draw your investment plans. With the right plan, you can avoid costly mistakes that can impact your success. Controlling the market is beyond our capability, but we can control our investment. This means that you must have a viable strategy that you must follow if you want to reach your desired goals. In short, your investing mindset tips include the following factors. Create a financial plan. Do not deviate from your financial plan. Do not be guided by emotions. Aim for the big picture. Buy and ignore. Avoid chasing the next big thing. When you are investing in cryptocurrency, it is vital to ensure that you do not change your plan in response to sudden market changes. You must focus on your long-term goals, and you will realize that you can easily achieve your goals. Markets are volatile, so you must concentrate on your goals and objectives to increase your chances of success. Shifting goalposts is a recipe for disaster that you should not entertain. Initial coin offering. In the cryptocurrency industry, an initial coin offering is more like an initial public offering, IPO. ICO is when a company looks for ways to raise funds after launching a service, app, or new coin. The investors can buy the offering, and they will receive a token in the form of cryptocurrency offered by the company. The token can come with some utility value, or it can just be a representation of a stake within the company's project. Startups that want to offer new services or products related to blockchain technology or cryptocurrency make use of ICOs. The ICOs can offer great potential to the investors to earn massive yields, but they can turn out to be fraud if not managed properly. It is vital to buy digital currency first if you want to participate in ICO. Other ICOs can turn out to be fraud, so you must exercise caution before you venture into this area. This sector is unregulated. Losses, scams, and theft. Trading in cryptocurrency sounds impressive, but it is not free from other risks like theft and scams. The risk that you are likely to face concerning cryptocurrency is that a central intermediary does not control it. This means that the onus is on you to take safety measures to store your cryptographic keys that help control the blockchain address. If fiat currency is damaged, it is replaced by the central bank. However, failure to adhere to security measures to protect your cryptocurrency can compromise its safety. Other threats that you are likely to face pertain to issues like hacking. Hacking is widespread, and hackers constantly refine their tactics to steal money and confidential information from unsuspecting online users. To date, hackers have stolen several tokens of cryptocurrency from ordinary users, wallet software, and other exchanges. Scammers also use different schemes to hoodwink the users to provide their tokens. Fake ICOs are commonly used by scammers to steal from unsuspecting crypto investors. Cybercriminals and hackers are turning their focus to digital currencies, and issues like phishing, money laundering, and cyber attacks are becoming widespread in the world of cryptocurrency. Security breaches are also a common occurrence as hackers try to steal confidential data from unsuspecting traders. The other challenge with cryptocurrency is that the users can forget passwords, and this can lead to irreversible loss. You cannot reset your digital wallet as you do with other applications. Therefore, when you lose your password, you are bound to lose your digital currency. Many people have lost millions worth of cryptocurrency as a result of issues related to lost devices or forgotten passwords. Cryptocurrency is extremely volatile. Crypto trading is highly volatile, and this is one of the biggest risks that you should be wary of. For instance, Bitcoin, at some point, lost more than 80% of this value in one go. The value of Bitcoin fell from around $20,000 to a measly $3,000. The cryptocurrency market can be extremely volatile, and investing in this sector can be stressful if you are risk-aversive. Crypto trading can succeed over time, but few investors can stomach the short-term changes they are likely to experience in their trading journey. There is still a long way for cryptocurrency to gain trust and acceptance by the generality of consumers and merchants. As it stands, digital currency needs some form of stability to help in determining a fair price of different goods. For example, the dramatic fall of Bitcoin's value in the above example leaves a conundrum. People are less likely to spend Bitcoins like the way they do with other fiat currencies as a result of their volatility. Crypto trading is based in speculation. To a larger extent, speculation is the major factor that drives people into undertaking different types of trade. Whatever asset you decide to trade, your bets are based on speculation where you anticipate that trade can go your way, and you can achieve a favorable result. While speculation is good for investment, you cannot get any guarantee that the trade will continue to perform in the same way in the long term. The main problem with cryptocurrency is that it is a relatively new form of investment, making it riskier than other types of stocks. it is still to be proved if cryptocurrencies will gain popularity like fiat currencies or the hype will fade away in a few years. This uncertainty can make trading in cryptocurrency riskier than other forms of investment. Other risks. Other risks are associated with owning crypto. You cannot trade cryptocurrency on the traditional stock market exchange, making it difficult to deal with. Most cryptocurrencies are traded via crypto exchanges, and some of them do not exchange with cash. You may also need a special digital wallet to keep your coins so that you can exchange them for cash. Cryptocurrency cannot be a trusted method of holding value since it is something intangible. Up to date, it is still not very clear what backs the value of cryptocurrency. The value of fiat currency is determined by gold reserves stored somewhere in the vaults at the central bank. In this chapter, you familiarized yourself with all the reasons why some people remain skeptical about digital currencies, regardless of their promise to offer high returns. Many people view the blockchain as a transformative industry that is capable of disrupting the global economy like the advent of the internet did in the 1990s. However, you need to be careful and understand the risks involved before you invest in cryptocurrency. You need to understand the complex security issues involved in digital currency. You must take your time to learn the common pitfalls that many crypto investors usually make. Trading strategies for beginners. Paper money is going away. Elon Musk. Have you been following the crypto market lately? Are you intrigued by the lucrative aspect of trading? Do you want to enter the cryptocurrency market but don't have a strategy yet? The strategies you choose to utilize for trading can make or break your business. There's no doubt that digital currency is the future of money. People from all over the world understand this. This is a reason why cryptocurrency traders are breaking records. Almost everyone who watches the news knows how profitable trading in cryptocurrency can be. Although there are a lot of big-shot investors who doubt the success of cryptocurrency, the constant rise in crypto rates cannot be ignored. The cryptocurrency market may encounter frequent dips and highs, but that's what makes it so attractive. If you follow the right strategies and take the time to understand the nitty-gritty of cryptocurrency trading, you can earn a fortune in a surprisingly short time. If you are a beginner in cryptocurrency trading, this chapter will help you understand the most common and basic strategies used by experienced traders. In this chapter, you'll discover some superb short-term trading strategies. In addition to this, you'll learn about the concept of time frames and a few methods used for analyzing short-term trading. With that said, this informative chapter will guide you through the strategies used for long-term trading and methods to expand and diversify your portfolio. By the end of this chapter, you'll be able to trade safely, profitably, and learn to manage the risks involved in trading. Strategies for short-term trading. The main objective of short-term trading is to earn a decent profit by buying and selling large quantities of low-priced stocks. It all comes down to being on a constant lookout for potential candidates that can earn you a good profit. In addition to this, you need to be aware of the stocks that you must avoid. With that said, a lot of investors fall into the trap of believing the information they find on the streets or the news. Regardless of how solid a tip is, you must always research yourself. The following trading tips found in the financial pages of a magazine are not always profitable because by the time you get the information, the market is already reacting to it. This is why we include some basic strategies that you must follow to find profitable trades at the right time in this section. Breakout trading. One of the most commonly used strategies by traders around the world, breakout trading offers a good profit to those who can time the entry perfectly. In breakout trading, traders wait for a stock's price to break out of a certain range. Most stocks tend to have a fixed range of highs and lows. When a stock breaks out of its upper range, the chances are high that the stock's price is going to increase further. This is the perfect time to buy the stock. Short-term traders wait for the perfect opportunity and buy a large number of shares in the hope of selling the shares when the prices hit a new high. The breakout trading system is best for day traders and swing traders. It is best to enter the market at the start of a new trend so that you can ride the trend from start to end. To accomplish this, you can utilize limit orders so that your trade is executed without you having to monitor the market constantly when a breakout occurs. Momentum trading. One of the most utilized strategies of trading is the momentum trading strategy. In momentum trading, the idea is to analyze the movement of stock to understand whether it is rising or dipping. Most readers tend to buy and sell assets based on the strength of the current movements and trends related to stock. It is believed that if the momentum of the current trend is strong, it is most likely to continue in the same direction. To be an expert at momentum trading, you should focus on the direction of the stock's movement rather than focusing on the top and bottom. If the price of a stock rises in the short term, it will attract traders and investors to buy the stock. This will further increase the price of the stock. If the stock price is decreasing in the short term, traders will try to sell more of the stock. As a result, the price of the stock will fall further downwards. Range trading. A popular strategy among short-term traders, range trading occurs between the lines of resistance and support. Although most long-term traders may find range trading a little ineffective and boring, short-term traders find numerous opportunities to book profit with range trading. Traders take advantage of stocks that usually trade between the two lines. Knowing the range at which a stock usually increases or decreases in price can be utilized profitably. When the stock is near the bottom range, also known as the line of support, the stock price is likely going to increase. Similarly, at the line of resistance, the range where the stock prices usually start to decrease, traders book profit by setting limit orders. If you want to book profit with range trading, enter the market when the stock is around its known line of support. This will mean that when the stock oscillates upwards in price to reach the line of resistance, you can sell your shares and book a generous profit. Reversal trading. This strategy can be utilized perfectly by those traders who can identify when the direction of a stock's movement will change. The change in the movement of a stock is known as a reversal. It is important to note that the reversal of a trend can happen in either direction. To understand it simply, reversal is when the sentiments of the market change and a new trend starts. When the movement of a stock is downward, a bullish reversal is what indicates the change in direction when the stock starts to move upwards. Most expert traders identify the reversal of a downtrend or uptrend to utilize the change in the market sentiments to book their profit. Short-term traders can benefit from reversal trading if they can effectively identify and enter the market at the most advantageous point. However, if you are a short-term trader, make sure that the trend is in full reversal before you buy a stock. The concept of time frames. If you are a beginner in trading, you need to understand the concept of time frames. The amount of time for which a trend lasts in the market is referred to as a time frame. The time frames can range from minutes, hours, days, weeks, to years. Most profitable traders utilize time frames to understand the common trends and cycles of the market. In short-term trading, trades utilize primary time frames such as minutes, hours, and days to confirm the movement of the stock and enter the market at the right time. The traders involved in high-frequency and day trading benefit the most by analyzing the immediate time frames. However, it is crucial to keep the other time frames in mind to identify trends and patterns that take place in the market. Being a short-term trader, if you successfully analyze the time frames of a stock correctly, you can greatly increase your chances of booking a profit. You can easily identify contradictions and discord between time frames if you learn to read them successfully. This will help you improve your timing of buying and selling stock to generate the most profit. Time frames help you to perfect your entries and exits from the market with minimum risk and good returns. By reading time frames successfully and implementing your strategies effectively, you can make confident decisions to accomplish your trading goals. Analysis methods used for short-term trading. To master short-term trading, you must be able to analyze the movements of the market. Every trader has the opportunity to calculate the best timing to buy and sell, along with identifying the best stock. Almost all trading platforms provide you with detailed information that can help you analyze the trend and cycles of the market. This section will discuss the most common analysis methods often used by short-term traders to successfully generate good returns. Follow the moving averages. Simple moving averages are nothing but the average price of a stock over a given period. Moving averages of a stock can be found in its charts. You can find out the moving average of stock for a period of 15, 30, 50, 100, and 200 days. The simple moving averages will help you get an idea of whether a stock is moving upward or downward. To have a profitable trade, it is best to buy shares of a stock that has an upward inclined moving average. On the other hand, if you are looking to sell a stock, find one that has a declining moving average. Observe patterns and cycles. Observing and identifying patterns and cycles of a market can help you successfully enter and exit with a good amount of profit. It has been observed that from November to April, the market sees the most gains, so entering a market at the start of November is a good move. Similarly, the months from May to October are generally static in returns as compared to the remaining months of the year. As a short-term trader, you can utilize these cycles and patterns to your advantage. It will also help you perfect your entry and exit timings in the market. Identify market trends. For trade, it is essential to have a sense of identifying market trends. It is best to sell your shares when the market trend seems to be negative. Alternatively, you will profit by buying stocks when the market trend is positive. In addition to this, you should buy very little during negative market trends and sell as little as possible during positive market trends. If you try to trade against the market trend, the chances of having a successful trade decrease dramatically. Managing the risks involved. It's a no-brainer that trading is a risky business. To be a successful trader, you must know how to effectively manage the risks involved in trading. You can only be a good trader when you maximize your returns with minimum risks. You must be prepared to protect yourself from sudden market reversals. It is best to understand and utilize buy stops and sell stops while trading. To understand it simply, buy and sell stops are orders to stop buying or selling a stock when the prices reach a high or low. These automatic orders or trades are carried out without you having to constantly monitor the market. So if you have proper orders in place, you can avoid incurring losses during a downtrend or if the market crashes. According to trading experts, make it a general rule of thumb while short-term trading to set your buy stops and sell stops within 10% of the initial price at which you bought the stock. It is crucial to remember that losses are impossible to avoid in trading. If you manage and minimize your risk, the losses will significantly be less than the gains, and you'll come out profitable from your short-term trading. Strategies for long-term trading. When a trader buys and holds an asset for more than a year, it is known as long-term trading. In long-term trading, the traders do not bother themselves with short-term movements in stock prices. Long-term traders are more concerned with long-term trends and the momentum of the market in a larger time frame. The analysis methods and trading strategies used in long-term trading are similar to short-term trading strategies, except the fact that in long-term trading, the focus is on a larger scale of time. Typically, in long-term trading, traders hold their position for a longer period to gain a larger profit. To help you understand the strategies for long-term trading, here is a bullet list of the most commonly utilized strategies by successful traders. Value trading. In this strategy, traders select the stocks that are undervalued and contradictory to the company's earnings potential and long-term fundamentals. Buying a stock when its price is deflated provides an opportunity for traders to earn profits when the stocks increase in value. Benjamin Graham strategy. Also known as the intelligent investor strategy, this is when traders select stocks based on high earnings to fixed charge ratio and low debt to equity ratio. In simpler terms, the stocks that promise future growth in terms of cash flows and earnings are favored by the traders. Naked trader strategy. In this strategy, traders select the stocks from small and mid-cap companies that have shown profitable earnings and significant growth in the recent past. In addition to this, the value, momentum, PE ratio, and PBV ratio play an important role in stock selection. Methods to expand and diversify the portfolio. Diversifying your trading portfolio is probably the best and easiest way to reduce your risk. By not putting all your eggs in the same basket, you can reduce your chances of incurring huge losses. As a rule of thumb, try to diversify your portfolio so that you can enjoy stable returns with reduced risk. While buying stocks of companies from different sectors is a good start to diversifying your portfolio, here are other methods that you should consider. Spread your investments. Do not put your wealth in similar stocks or sectors. You can also consider investing in commodities and real estate apart from cryptocurrency and mutual funds. Invest in bonds and indexes. Mix up the investments in your portfolio to include fixed income and index bonds. This will help you stay safe from market uncertainty and volatility. Keep adding to your investments regularly. This will help you cut down on your investment risk and build your portfolio over some time by investing the same amount of money over time. To sum up, let us take a glance at the key takeaways from this chapter. We discovered the various strategies utilized by expert traders for short-term trading. The breakout momentum, range, and reversal trading strategies are the most effective and commonly used trading strategies to gain significant profits in short-term trading. In addition to this, we discussed the concept of time frames and how they can help you uncover the underlying trends and cycles of the market. We also discussed the various analysis methods used for short-term trading, such as moving averages, market cycles, and trends. With that said, this chapter also covered the basic strategies used in long-term trading along with some effective ways to minimize the risks involved in trading. And finally, the chapter concluded with some methods to expand and diversify your portfolio to help you gain stable profits with minimum risk. Automated trading. Through technological innovation and the exceptional growth of digital systems, we have revolutionary financial assets such as cryptocurrency. More importantly, we also have systems and methods of trading that were never possible in the past. Cryptocurrency could never have been possible had we not developed computers and digital systems, but through these same technologies, we can also revolutionize the way we trade financial assets. Just a few short decades ago, stock trading, futures contracts, banking, and every other financial operation was completely manual and required buyers and sellers to come together physically to transact. Digital systems and IT, together with the internet, have made it possible for us to do business with a person in a different part of the world without ever meeting them or even seeing them. Just a few years ago, we would never have reached someone even in a different part of the same city as communication methods weren't that advanced. As things changed and communication got better, we could communicate, but business was still slow since there was no way to transact virtually. Moreover, this improvement in how easy and possible it is to connect us with people around the globe also opened doors to more investment opportunities. Today, we are not confined to what is locally available. Rather, we can access financial markets all over the world and trade assets that are thousands of miles away from us. Moreover, we never have to interact with these assets ourselves, as everything can be done online. Automation in business. In the same way, technology has impacted investments and has had a similar effect on trading and commerce. It has allowed individuals and businesses to trade with other institutions across the globe and given everyone access to a global market. Consumers can buy from an international market, whereas businesses can sell to a global audience. This means that businesses have more opportunities than ever before, while customers have more options to choose from. This globalization of trade makes the market very competitive and gives both buyers and sellers a lot more opportunities. However, IT and the internet have also greatly affected the way business is carried out, the actual processes used, and how tasks are completed. A good example of the impact of technology in this regard is how commonly businesses create a website and establish their presence online. Regardless of which industry a business is in, businesses all over the world make their websites or at least a social media page to help people find them online. This goes to show how important digital presence has become and how much of a norm it has become to use the internet to find businesses. Similarly, basic processes like payroll, daily accounting, attendance, and several recurring operations are digital for most businesses. Even small shopkeepers find it much easier to manage inventory through software rather than by managing books. One of the main benefits of these digital systems is that they can make it possible to automate several processes. At the same time, more complex solutions that use AI may even be able to learn the significance of various tasks and make decisions based on what they have learned. Inventory management systems can automatically place orders to stock when inventory levels reach a certain threshold, just like how payroll systems can automatically generate paychecks using the information provided by the integrated attendance software. However, even by using simple rules, automation can effectively help people invest and trade commodities. When it comes to cryptocurrencies, several services provide automated investment and trading services that help you minimize loss and maximize returns. Let's look at a few of the most common crypto investment solutions and their unique features. Automated investments. While automated trading allows you the freedom to live your life while your investments happen in the background, they don't have to be limited by basic price boundaries that you define, like what you would do with a stock trading service. Rather, automated cryptocurrency trading services give you the flexibility to base your trading protocol on a variety of metrics so you can customize your strategy to meet your requirements. Some people prefer to base their trade decision on defined prices, while others might want to pursue a more sophisticated path in which their portfolio automatically rebalances based on proportional values. Let's look at some of the best investment options and how they can work for you. Crypto Hopper. Out of many automated crypto trading solutions, Crypto Hopper boasts a complex technical side that is neatly tucked under a user-friendly interface designed to help new traders familiarize themselves with different trading processes. The main advantage of Crypto Hopper is that it allows a lot of the complex analysis to be automated so that the user doesn't have to manually tweak every setting. However, this doesn't mean that the user doesn't need to know what all these metrics mean. It simply makes it easier to manage them. Crypto Hopper welcomes new users with a free demo to try out the platform. If users choose to use Crypto Hopper full-time, they will need to have a minimum deposit of €250 or £250 to begin trading. This platform is home to a wide variety of brokers and offers a plethora of trading signals that traders can use to earn exponential profits. However, user competence plays a big role in how effectively they can protect themselves from losses and earn profits. Some investors have been able to win fantastic profits on this platform even as beginners by using the different safety systems installed on this platform. One of the best features of this system is the deposit and stop-loss limits, which helps minimize the risk of your entire portfolio becoming a victim of market volatility. If you are brand new to crypto trading, it would be a great idea to spend some time on the demo account and get accustomed to how the app works and how the market behaves. Ideally, you should have at least a fundamental understanding of the market and the commodity that you want to trade rather than blindly investing money. This is the only way that you will be able to harness the volatility of the market. Otherwise, you are simply riding waves and hoping you will find land. Once you are comfortable in the demo account, you can consider putting some real money on the line and moving into live trading. However, as a first-time live trader, it is advisable to use the trading limits when you trade. Extreme volatility in the market is something that no one controls, and even seasoned traders have ruined entire portfolios because they exposed themselves to this threat. 3 Commas. The second automated trading platform focused on digital currency assets is 3 Commas. Using automated trading bots, this platform aims to minimize the amount of work that traders have to put into their portfolios to earn a profit. With an advanced automated trading process, individuals can make really intricate trades without having to put in a lot of effort. If you are the kind of person who can really narrow down exactly what they want to do in a trade, then you can delegate the entire process to 3 Commas, and the platform will handle the actual execution. However, even with all of its features and services, this is still a platform that can be very beneficial for a beginner as well. 3 Commas incorporates a lot of safety features that are vital for new traders, and they also come in handy for more experienced traders. After all, even with years of experience and sizable portfolios, it's in the best interest of even large traders that they keep their losses low. If they can stay away from loss and keep risk at a minimum without too much effort, that's even better. More than just setting trade limits and creating market orders, 3 Commas allows you to automate trailing orders, composite bots, create short sell protocols, and more. One of the unique features of 3 Commas is that it allows you to copy the trading parameters of another trader. This is a fantastic option for people who aren't familiar with the various metrics and don't know how to set up trading parameters properly. You can choose your ideal trader, replicate how they set up their trade protocols, and hopefully enjoy the benefits of their knowledge. It goes without saying that this will work best when you either align yourself with a top trader or look for a trader who shares your interest in a cryptocurrency and style of trading. Moreover, 3 Commas breaks down its services into 3 membership tiers, starting from roughly $25 per month, going all the way up to nearly $80 per month. MetaTrader. MetaTrader stands out in the financial trading services for a couple of really important reasons. Firstly, It is one of the few trading interfaces which offers its services completely free of charge. You can buy services that give you additional features, but the basic platform is free for anyone to use. Accessible through the web and mobile, all you need to do is sign up and get started with trading. The second feature that makes this an incredibly popular choice for a large number of traders is the fact that it is not only restricted to cryptocurrencies. Rather, it allows you to trade a very wide range of financial instruments, whether you are looking to trade Forex, futures, stocks, metals, and of course, digital currencies, among many other things. If you are interested in spreading out your investments across a range of financial assets, this is the service that will let you manage everything from a single portal. A third unique feature that makes MetaTrader a fantastic choice is the option to create custom indicators. MetaTrader comes loaded with 30 standard indicators right out of the box, but it has the option for users to build their own as well. However, this is an advanced feature that will resonate more with seasoned traders with very specific requirements. Trading bots. Trading bots are basically specialized pieces of hardware that assist traders in trades. Some perform relatively mundane and easy tasks, while others can perform really complicated trades. When using a trading bot, it all boils down to how flexible the software is, how well you can adjust it to suit your preferences, and how effectively it does what it is meant to do. However, even with the intense functionality that they offer, these are options that aren't very beginner-friendly for the simple reason that it takes quite a lot of expertise and in-depth understanding to get them to work right. It's like managing a high-performance athlete. They are amazing physical specimens, but it requires a solid coach to really direct their efforts and make them profitable in one specific area. Similarly, while it is not very complicated to get a trading bot, it can be difficult for a beginner to identify the exact kind that they need and then be able to properly set it up to do what they want it to do. However, if you know or are willing to learn how to manage a trading bot, they are extremely powerful pieces of software that can be incredible trading partners. With the ability to watch and learn the market, predict risk, and do many other things, having the right trading bot is definitely a very valuable addition to any trading team. Python programming. Python is arguably one of the most favorite languages with data scientists today. In fact, data scientists, crypto coders, and traders are making use of this modern language as it is a great tool for anyone working with data. Not only does it offer incredible functionality and versatility in the things that can be done within, but it is relatively easy to learn and has a wide application. Whether you are looking to mine coins, create a custom market monitoring software, or even develop your very own cryptocurrency, you can achieve all your goals through Python. One of the main attractions for people to work with Python is the fact that it does not require compilation. Unlike other languages, such as C++, which require a piece of code to be compiled before machines can understand it, Python can be run directly as it is, which reduces a very time-consuming process in the life of a coder. Crypto exchanges. Just like traditional stock exchanges, crypto exchanges serve as a platform where sellers and buyers of different cryptocurrencies can come together to trade their assets. Crypto exchanges share many of the traits of traditional exchanges in how they are structured and how they perform. However, there are some broad differences in the main types of cryptocurrencies which we will discuss below. Centralized. Centralized exchanges are generally governed by a group of companies or a single company that overlooks the exchange's performance and offers its services to users that are trading through it. As the exchanges rely on governing body for direction, they have tighter regulations and legislation that both traders and cryptocurrencies have to adhere to and are considered more secure than other exchanges. Moreover, these exchanges also allow for traders to trade from crypto to crypto or from fiat currency to crypto. Due to their highly secure infrastructure and relatively easy access, they are popular with new traders and offer a better user experience than other options. The fact that these governing bodies also act as custodians of funds makes these exchanges a lot more reliable since every part of the trade process is to quite an extent in the control of these governing bodies. Decentralized. As the name suggests, these exchanges move away from the regulated structure of the centralized exchange and place a greater emphasis on enabling traders to connect with each other directly, which is why they are also sometimes referred to as peer-to-peer exchanges. As the intervention of a governing body is reduced, many people think that these exchanges are not reliable and less secure. Though, on the upside, these exchanges offer a lot more freedom, privacy, and potentially a higher scope of earning for traders. Moreover, these decentralized exchanges deal exclusively in crypto-to-crypto trades, so it's not possible to enter with fiat currency, let alone trade with it. One of the major downsides to working on a decentralized exchange is that the investors often find it difficult to offload a currency when they want to sell and buy a currency when they want to invest because they have relatively low liquidity. Hybrid exchanges aim to provide traders with the benefits of the two previously mentioned exchanges while trying to eliminate the downsides of both of them, so the client gets the best of both worlds. By using smart contracts, hybrid exchanges try to improve their security and reliability, and without a governing body, they try to give traders a bit more room and a bit more freedom than centralized exchanges. Keeping your investment safe. Now that you've learned everything you need about cryptocurrencies, including different types, trading platforms, and strategies, there's one last important aspect to bear in mind, perhaps the most pressing for beginners like yourself. Given the risky nature of cryptocurrency investments, you must be wondering how you will keep your investments safe, especially when there is regular news about horrifying cases of scams, enough to make you want to drop the whole idea altogether. In this chapter, you will learn about the different types of scams, how to spot them, and how to deal with them. You will also get to understand the basics of safe cryptocurrency investing to make sure you don't fall victim to these malicious attempts. This is a critical stage of your cryptocurrency learning, so make sure you have a pen and paper handy and start taking notes. Most common scamming methods. Over the years, cryptocurrency scamming methods have become more sophisticated and much harder to detect. However, through keen observation, you can identify a certain pattern to confirm if/when you're being targeted. Below, you will find more information about the most common scamming methods, the risks they entail, and how to protect yourself against each. Classic scams. Scams that fall under this category are the ones that have been around for quite some time, yet somehow are still working, especially with newbie traders. Random emails from questionable addresses and strange phone calls are among the top classic scamming techniques that threaten traders and put their investments at risk. They're very straightforward and sometimes even naive. However, you'd be surprised how many people tend to forget all about common sense when there's money involved. Some of the typical scenarios involve a request from a scammer to immediately transfer X amount of money to avoid being taxed for your cryptocurrency winnings. Your lack of experience and ignorance of the investment process will cause such panic at the possibility of being incriminated that you'd be willing to respond without pausing to consider if this even makes sense. Here's how you can protect yourself against classic scams. Always be suspicious. Given the modest concept behind classic scams, there really isn't much to do except for relying on your good judgment when receiving any suspicious correspondences. Look into the email address and request some kind of verification to ensure that the sender/caller is who they claim to be. If you're ever asked to make any financial transactions, there should be an official payment slip from an authorized entity. You can also take advantage of the hundreds of online forums and cryptocurrency platforms where you can post an inquiry about any fishy requests you receive. More experienced traders will definitely share some valuable insights and tips on how you should respond and what you need to do for future reference. Phishing. Phishing is one of the most common social engineering scams that have to do with stealing sensitive data. The scammer usually sends an email posing as your cryptocurrency platform or wallet provider containing a coded link. Once opened, you're directed to an illegitimate website where the attacker gets access to your personal information, online accounts passwords, and credit card details. Basically, any information that can be linked back to you could be within their reach in a matter of seconds. With phishing, your trading details, especially your wallet keys, are susceptible to confiscation, which means that the entire wallet you've spent months or maybe years building could be at risk. For less experienced individuals, phishing could be difficult to detect. However, some of the precautionary measures that you can apply are: don't open any links. Unless you are 100% sure that the links you receive in an email are legitimate, you should never open them. This applies to messages you receive on any platform, as there's a chance your email address is hacked, and the attacker has access to all of your online accounts. Verify the URL of the website. Only encrypted websites that start with HTTPS are considered genuine and safe for you to visit. If you receive an email with a link connecting you to an unencrypted website, this is your cue to run as fast as you can. Changing your passwords after similar incidents wouldn't be an overreaction. It's actually a good way to ensure that your funds are safe and sound. Besides checking the encryption, you can also call up the claimed sender, whether it's your bank or your cryptocurrency platform, and ask for their confirmation about the email and the attached link. When it comes to ensuring the security of your investments, there's no such thing as too much. Stay up to date with the latest phishing techniques. It's your responsibility to protect yourself against phishing scams. Your wallet provider, your bank, or any other entity cannot be blamed for your negligence. Nowadays, there is a myriad of sources that you can rely on to stay updated about the latest phishing techniques that are trending worldwide. Make sure you join the conversations that have to do with cryptocurrency trading risks to have a clear idea about the right course of action post-scam. Illegitimate cryptocurrency exchanges. Beware of the cryptocurrency deals that might seem too good because they're fake more often than not. Transactions that offer you special perks like tempting initial depositing bonuses or special trading schemes specifically designed for your needs should make you wary. The scammers might pay you back part of the promised funds, however, not for long. It's all part of the play until they can acquire as much of your funds as possible. Unfortunately, these scams are not very easy to spot since sometimes public figures and social media influencers promote them. This makes unsuspecting traders like yourself more willing to trust the promoted transaction and putting your funds at risk. Only trade in trusted exchanges. As a general rule, regardless of how attractive an exchange seems to be, unless it's popular and common among traders, don't fall for it. Be very skeptical and don't save any efforts in researching and verifying the exchange. Given the extent of the associated risk, you will judge it as a small price to pay if you get to keep your funds secure and out of the reach of skilled scammers. Look for reviews from other users. Sometimes the best way to confirm that an exchange is indeed legitimate is to research reviews from other users. Make it a point to only go with exchanges that seem to be in high demand and other users are sharing positive feedback about their experience. Refrain from sharing personal data. And not only with cryptocurrency platforms. As a general rule, you shouldn't feel forced to disclose your personal information or passwords on any platform. Nor should you make any financial deposits unless you understand where exactly your money is going and how it will be used. Initial coin offering, ICO, scams. Companies, usually startups, issue a new cryptocurrency as a way to raise funds for interested investors. This offers scammers a great opportunity to take advantage of the situation, either through creating a completely fake currency from the start or redirecting the public traffic toward a fraudulent website. In both cases, the scammers are using the ICO as a cover for their malicious attacks. Research the ICO thoroughly. With the abundant stories about people who became rich almost overnight after having invested in the ICO of one of the major cryptocurrencies, it's easy to understand why and how one would fall for the fake ones. After all, the whole idea of becoming a trader is to make money. So when a seemingly lucrative chance comes your way to become one of the early investors promising attractive returns, you should pay attention but tread with caution. Use governmental resources that offer valuable tips about telling a legitimate ICO from a fake one. Furthermore, you should do your own due diligence to find out who's behind this ICO, what are the specifics of the new cryptocurrency, and why it is being released in the first place. In other words, you should play detective and not give in unless you have all the assurances you need to believe that an ICO is, in fact, a real one. Find out if the entity behind the ICO is compliant with the law. Even though this seems like reasonable advice, inexperienced traders often ignore it in their excitement about becoming early investors. Cryptocurrency investments are governed by the Securities and Exchange Committee, SEC, in most countries. However, unlike regular securities, in cryptocurrency markets, investors have little to no protection. This makes them more susceptible to fraudulent deals and fake investment opportunities. In the case of a new ICO, the SEC has a lot of laws and regulations to be followed and fulfilled before they could be approved. When an ICO opportunity comes your way, you should confirm compliance with governmental decrees before you make any decisions about whether or not you should partake. Phone porting scams. The idea behind phone porting scams is very basic. Scammers target your cell phone's SIM card to gain access to your crypto wallet, reset the password, and take over your account. In a matter of seconds, you could lose it all. Scammers can take a hold of your cell phone in multiple ways. Bribing your phone carrier or hacking your phone to steal your personal information data are only a few of the ways you could be under the threat of SIM scammers. Don't link your phone to your crypto wallet. A simple and easy way to protect yourself against phone porting scams is to avoid linking your phone to your crypto wallet. That's fairly easy in theory. However, it's quite the hassle in practice because, like most people, you probably rely on your phone for everything, including managing your crypto wallet and trading. But the risk of getting scammed and losing your funds is too big to take any chances. Use an authentication app. To authenticate your account and avoid phone porting, replace your phone authentication with one of the specialized authentication apps. Available on common app stores, you can find a selection of authentication apps that come with a variety of security features to ensure your data protection. However, before you download any random authentication app, you should make sure that it actually does what it claims to do. Search for others' reviews and look into the listed features before you invest in one of the paid-for apps. Giveaway scam. Here, the scammer takes over one of the public figure's accounts to announce fake cryptocurrency giveaways in exchange for an initial deposit on your side. The scammer makes it look like their accounts are real and even verified on social media platforms to call potential victims into immediate action. As a beginner, coming across similar attractive offers could be hard to resist, especially if it looks legitimate and is sponsored by popular celebrities or other trusted parties. Once you fall for it and decide to pay the asking price to participate in the giveaway, the scammer takes your money and disappears into thin air. Use a blockchain explorer. A blockchain explorer is software that keeps track of all cryptocurrency transactions and can provide you with a real-time information about the movements in the blockchain network. This should show you the inflow versus the outflow on the provided blockchain address. If you notice the outflow is insignificant in comparison, then it's probably a scam and you don't need to dig any further. Be suspicious when a celebrity is claimed to be doing a giveaway. Assuming that celebrities have more awareness than to get involved in these shady deals, anytime you see a giveaway being hyped about, don't buy into it. Practice caution and try to read between the lines. If you look closely, you'll almost always find a spelling mistake that gives the scam away. Pyramid scams. Also known as high-return scams, pyramid schemes have been around for a long time, way before cryptocurrency. This is when the scammer convinces you to deposit a payout to get under his network or pyramid and make unusually high returns. The scammer is already working in parallel with other unsuspecting traders, promising them the same. What happens next is that the scammer pays you from the other investors' payout funds to make you believe in the legitimacy of the process and that it's actually working. Before you know it, the scammer disappears with the money, and you and the others are left only with the regret of getting involved in the first place. Keep in mind that unrealistic returns are almost always a scam. When you're promised exaggerated returns, you should always get suspicious, especially if it's fairly easy to find out the average returns on cryptocurrency investments. Don't get into a transaction where you're asked to bring in other investors. As mentioned above, from your experience with the old-school pyramid schemes, if a cryptocurrency exchange comes conditional on bringing in other investors, simply run the other way. Authentic cryptocurrency platforms might offer you some sort of bonus for bringing in a new investor on board, but it's never conditional on accepting your buy-in. The above scams are among the latest, most common scams that you need to be aware of as a beginner in the world of cryptocurrency. In addition to the mentioned tips on how to avoid falling for each, you would be pleased to know that you can actually play an active role in maintaining the security of the cryptocurrency network through staking crypto. What is staking crypto? In an attempt to make the cryptocurrency network even more self-sufficient, this process entails having investors support in securing and sustaining the network in exchange for financial compensation. As an active member, this should be an interesting opportunity for you to ensure that your and other investors' investments are protected from scammers. How does staking crypto work? Interested traders carry out a process called proof of staking, POS. This happens as traders put away some tokens to validate all the transactions that take place through the blockchain. In addition to the enhanced security, one of the main benefits of POS is saving otherwise wasted mining efforts to validate each new transaction. Risks of staking. Despite its benefits, validators involved in staking crypto are burdened with a set of risks, including long staking duration. As a staker, you might be asked to lock up your tokens for a pre-specified duration. If, at any point, the value of your assets drops and you can't reach them to sell, this will impact the value of your aggregate wallet. However, there is a workaround where you avoid stackable assets that come with long staking durations. Market fluctuation. The asset you choose to put up for staking could bear a drop in value far bigger than what you're gaining in staking returns. Although hard to predict, you can try to be more assertive when choosing which assets to stake. Associated validating costs. As a validator, you will need to invest in hardware and electricity to run the validator node. So you should always make sure to keep your costs below your staking returns margins to remain profitable. This chapter should help you trade safely as you venture into the vast world of cryptocurrencies. Make sure you understand the implications of your investing decisions and the amount of risk you're bearing at all times.